We're now just about 2 months or 2.5 months into 2023. How have stock markets performed so far this year?
Well, good afternoon, Ole Christian. It's really nice to be with you today. So looking at the markets after being underwater for most of 2022, markets seem to have just about come up for air this year. We'll see what happens today. It doesn't look good, but so far it is a pretty rough day on the market. So far this year, Europe is the best performing region year to date. And developed market continues to do better than the emerging markets, although emerging markets caught up somewhat towards the end of last year. Now, I think what's really notable looking at the sectors is the high dispersion between the returns from the worst sectors like healthcare, utilities, and banks, of course, down maybe 5, 10+%, while the best performing sectors like IT is actually up between 10 and 20%. Something that I believe will continue in the quarters ahead and which really speaks to the need for active investors. Looking at the 12-month graph on your screen now, we can see that Norwegian investors with the weak crown have had 13% return, while US dollar investors have lost 5% of value. Now, there is still a lot of macro and political information to digest, let alone what is happening at a company level. Investors are digesting everything from COVID opening in China to the impact of new inflation figures on interest rates and, of course, on the rising cost of inflation and the cost of living and its effect on consumer sentiment. And of course, we can't get away from the recent latest news the market is struggling with today or this last week, and that is the Silicon Valley Bank that folded last Friday and the fear of a broader contagion.
Absolutely, and we don't really know what's happening, where this is going to end quite yet, Alexandra, and we'll certainly come back to the bank situation later. But now let's turn to our funds. What does the picture look like in terms of their performance this year?
Well, so far so good, I would say, for SKAGEN's fund in 2023. At the end of February, all equity funds had delivered positive absolute returns in NOK. After today, I'm not quite sure in euros. It might be a couple of them slightly underwater. And we see that 4 of our 5 funds were ahead of their benchmarks as of the end of February. So March is turning out to be a more nervous month so far regarding absolute performance. So we will see where we will end in a couple of weeks. We are of course very pleased with the overall strength of our funds this year, but stress that we are focused on delivering long-term results. So we don't put too much weight on short-term performance.
Right. Now, just to pick up a bit on that, what's your assessment of the fund's returns in the longer term?
Well, here I can confirm that the majority of our funds are ahead of their benchmarks over the last year and also over the last 3 years. So the picture for the longer term is quite positive. And, you know, I'd like to just show you that we are also at the 3-year anniversary for COVID, for the COVID market crash when the stocks fell 12%. I think it was sort of March 16, 3 years ago. So it feels like a good time to sort of assess performance. And we also know that commentators have described this as the big reset or regime change for the stock markets, where the old playbook doesn't count anymore. Now we're into more the way things were in the old days. So if you look at this slide here, I have a picture showing one of our funds, SKAGEN Focus, but we can also use it for SKAGEN EVEX, another of our funds. They have both roughly doubled in value since the big reset. And here you can also see that SKAGEN Focus has massively outperformed its benchmark. So I think the key message for our clients is that SKAGEN and our funds are delivering for them.
Absolutely. Now let's change the subject a bit and turn our focus to valuation. How would you characterize the investment environment at the moment? Is it supportive for value investors like SKAGEN?
Yes, absolutely. Broadly speaking, or simplified, value stocks are stocks valued on earnings here and now, while growth stocks are valued more on the long-term high earnings growth and tend to be much more expensive. Now, growth has the upper hand so far in 2023, but value has performed ahead over the past 12 months and since the big reset or the COVID reset 3 years ago. And over the long haul, it is widely acknowledged among investors and academics that there is a value premium. And we do expect this to continue, as value will continue to outperform growth over the coming years.
Yes, that needs to be. We need to see that happening, I suppose. What makes you say this? There have been many false dawns for values recovery in recent years. So what makes you think that this time is different?
Well, again, back to my cartoon here. With inflation, cash today is worth much more than cash in the future. Looking back at the last 10 years, growth stocks that have typically grown earnings by 10-15% per year, like Amazon, Google's, and Facebook's of this world, while at the same time, interest rates, which is of course the basis for discounting future cash flows, has consistently fallen since the financial crisis. So no wonder growth stocks continue to become more and more expensive. So it's true that growth has beaten value for sustained periods since the 2008 financial crisis.
And no doubt, this has definitely been the decade for growth stocks. What, in your opinion, has changed?
Well, simply, it's inflation. Now, I started forecasting rising inflation back in 2019, following the 10 years of monetary easing, basically resulting in free money. I was, of course, too early with my projections, and it wasn't until the recession following the outbreak of COVID and after billions of dollars in financial stimulus really marked the flipping or the tipping point and the big reset. So even more free money was made available, which led to bad capital allocation. And we all know this, where capital was poured into riskier assets like meme stocks or cryptocurrencies, Chinese real estate, and of course, highly priced and often loss-making tech companies or other growth companies. So rising inflation, starting by COVID and accelerated by the war in Ukraine, has now changed the rules of the game.
And indeed, inflation has been off the radar for so long, we're nearly forgotten about it. But where does this leave us now?
Well, now we are in a situation with rising interest rates to combat inflation since the start of 2022, resulting in capital having a cost once again. And investors are therefore incentivized to do more fundamental research to find assets that will generate real sustainable returns to cover the cost of capital. We're no longer in a position where the water raises all ships. So this becomes even more important when facing a possible recession, or at least an economic slowdown, where returns are likely to come under pressure. Current earnings become increasingly valuable to investors. So there are also longer-term structural tailwinds for value, like the need to invest more in infrastructure, to upgrade existing, and of course investing in the energy transition. And finally, hopefully soon, the rebuilding of Ukraine. So the companies that drive this, like materials and commodities, and provide the capital, like financial services, tend to come from value sectors. Finally, I need to get to the right slide here. Here we go. Finally, in terms of values, discount to the growth is still way above its historic average and has widened by a lot over the last 4 years, which can be seen on the graph here to the left. And it suggests that value recovery still has a long way to run, despite value outperforming growth strongly in 2022, as you can see on the graph here on the right-hand side. So I am a firm fundamental believer that money must have a price in order to channel capital to productive and sustainable investments. So value is regaining its crown, which speaks soundly to our investment strategies.
Money must have a price indeed. What about valuations generally? Can they tell us anything about expected returns?
The first thing to say is that the regime shift to higher interest rates no longer supports multiple expansions, i.e. more expensive shares. So for stocks to rise, we actually need earnings to increase. Now, I have a slide here where you can see the price earnings range over the last 30 years in different markets, with the blue line indicating average and the triangle where we are today. So the fact that valuations generally are below 30-year averages, as this graph shows, gives room for somewhat lower earnings without necessarily impacting the stock market. Most major stock markets, ex-US, are still cheaper than long-term averages, particularly in emerging markets and China. So history tells us that valuations are some of the most reliable predictors of future returns, and current price levels have historically been followed by good absolute returns. And even in the US, where prices are slightly above average, subsequent one-year returns have nearly always been positive, and 10-year returns have been in the range of 5 to 10% per annum 100% of the time.
Now let's look a bit ahead. You mentioned the possibility of a recession or at least economic slowdown. What impact might this have on the stock market?
Well, history tells us that markets tend to rise in 2 out of 3 years, and they have previously recovered strongly in years following drawdowns, similar to the one we had last year in 2022. So I have a graph here showing where you can clearly see that the number of positive years in the blue box clearly outnumber the negative years in the beige box since 1871 on the S&P 500. And it's also useful to remember that the largest falls in the stock markets historically are in the either before or during the first phase of a recession, often long before a recession is confirmed by the statistics. And then when it's first announced, that's when the markets do stabilize and then rebound.
Fingers crossed about that. What about risks? What keeps you and the portfolio team awake at night?
Well, always involves investing always involves risk, Ole Christian. The key is taking the right risks and making sure that we are rewarded for the ones we take. And stubborn inflation and interest rates continuing to rise is still the biggest risk to stock markets on an overall level. There's also the risk of an economic hard landing or severe recession. However, it does look like we are closing in on the end of interest rate hikes in the US. And we have to remember that the biggest pain is actually behind us, with rates going from close to 0 to over 4%. Another 50 or 100 basis points increases should be manageable. And of course, geopolitical risks are also or always present, I guess. But right now there are no major elections planned for this year, which will provide some kind of stability. But obviously, the situation in Ukraine remains difficult. And of course, the China-Taiwan-US relationship is also tense. But I do think I need to mention what happened last week. So last Friday, we saw the closure of Silicon Valley Bank. This was a product of poor bank management, corporate governance, and too little risk diversification. So their clients were mainly from the venture capital community with large uninsured deposits, which were invested in long-dated government bonds when interest rates were lower. These investments lost value as rates increased, and a more challenging environment led to clients taking out their deposits. We saw another bank fall as well last week. It was Signature Bank, with its clients centered around cryptocurrency clients. And I can confirm that none of our funds owned either of these banks, and so we have no direct exposure. Now, the share prices of banks internationally have taken a hit for two main reasons. The first is that investors are worried other banks could face similar problems. Second, bond yields have fallen as the market thinks that the Fed and other central banks will now be less aggressive in raising rates, which is less positive for banks. Now, our funds generally are either underweight banks or have similar exposure to the index. None are significantly overweight. Now, just to put some of these points in perspective. On the first point, I do not believe there is a massive contagion effect, and the reasons are Treasury has guaranteed that all deposits are safe. Only equity holders and potentially bond holders will be wiped out. Number two, bank regulations have massively increased since the financial crisis, resulting in banks being much more robust. And SVB looks to be an outlier. No other banks, even those who have suffered the largest share price falls, appear to have similar profiles in terms of uninsured deposits and risky investment portfolios. And lastly, there are also indications that some of our larger US holdings, like JP Morgan in SKAGEN Global or Citigroup in SKAGEN Växt, may be benefiting by picking up deposits from regional banks as business customers look to de-risk or diversify their deposit basis. However, I think it's also right to mention that we mustn't be fooled into thinking this is irrelevant for the global economy. Funding the banks is likely, or funding for the banks is likely to become more expensive, which again leads to lower economic growth. And on the second point about the market seeming to believe that the Fed will be less aggressive raising interest rates going forward, this has been taken as a positive by investors outside the banking sector, where stocks have not reacted as badly.
Right, so obviously this has stirred quite a commotion in the stock markets and especially today. How do you mitigate these risks?
Well, risks in general, I think it is possible to mitigate somewhat at both the company and the portfolio level, which is, of course, what we do. Now, at the company level, it's really important to do your analysis and understand what drives the value creation in companies, understanding pricing and buying power, demand and supply, substitution and competition. Okay. And of course, the company's ability to service debt and adjust costs are also important for company selections. And then on the portfolio level, diversification is key, either by geography, sector, risk factors, economic sensitivities. In other words, do not lay all your eggs in this one and the same basket. And of course, lastly, also valuation matters. Being value investors, valuation provides a margin of safety. Our holdings, funds are generally valued at a discount to the broader market.
Now let's talk a bit about the fun stuff, the opportunities. What's getting the portfolio teams most excited at the moment?
Well, the good thing about being global investors is that there are always pockets of opportunities somewhere. Now, I can mention emerging markets. Here you have 80% of the world's population and only 20% of the listed companies. Attractive on valuation grounds, particularly considering the economic growth outlook versus many developed markets. Currently, we are investigating opportunities in Brazil, many good companies with solid management and governance structures at attractive prices. And then I can also mention small caps, also very exciting, and the current discount to large caps was last seen during the .com bubble. So this is a very exciting space. And maybe the last area is, of course, a very unpopular area, and that is real estate. Bad news, negative sentiment is reflected in cheap valuations, and this should recover strongly as the environment improves and real estate tends to outperform during periods of lower economic growth. So just to remind you, our portfolio managers always do fundamental research on companies and never invest unless the thesis is attractive on a standalone basis. So with that level of research, they can in addition look for opportunities that will do even better under the reigning geopolitical and macroeconomic surroundings.
Knowing you, Alexandra, I feel pretty confident that you have some concrete examples.
Yes, of course, I have, Ole Christian. We have many exciting companies in our portfolios, and I'd just like to mention a couple of them. So the first one is a company in SKAGEN Global, and it's called Dollar General, and it's a discount retailer in the US with the thesis, I mean, Dollar General in itself is a solid company delivering fantastic returns to investors for many, many years. But in addition to that, it is a company that now is of course more popular among the general public because they need to trade down as inflation and higher costs are impeding on their wallets. And maybe another area which is totally different, and that's going to Japan. You know, Japan is totally ignored by investors around the world and has been for many years. And we have done extensive research on the political and financial developments for a long time, and we have good knowledge about Japan. And we have found that improvements in corporate governance and regulations that are unlocking value in Japanese companies. And I would like to mention SKAGEN Focus that has particularly been successful over the years in finding exciting opportunities. And the team recently invested in Japan Post, which may sound awfully boring. But as apart from the normal business, it is also the holding company of listed bank and insurance assets. And these will benefit from the positive central bank policy changes. And deeper, we find that Japan Post is valued at approximately 50% discount to its listed asset base. So a discount on a discount, it can't get much better than that. So the fact that others ignore doing the digging can be a great advantage to SKAGEN clients. And then one more, Krista, I would just like to remind our clients of the benefit of being long-term in excellent companies. Although the share price of Samsung has had both weak and strong years, the stock has delivered phenomenal growth and share price returns over the years, always at the cutting edge of innovation and a key technology in most people's lives. And growth has been driven by new waves of breakthroughs. Did I forget to change the slides? I think I did. Well, let's go to SKAGEN Global, to Samsung. Sorry about that, guys. Growth has been driven by new waves of breakthroughs, as you can see on the slide here, and technology adoption. Now, of course, the talk of the town is ChatGPT, which will drive the next flow of product innovations. Although SKAGEN clients have earned more than 10 billion NOK on Samsung over the years, it is still a key holding, which we believe will be a strong contributor also in the years ahead. Samsung is not only in SKAGEN Kontiki, but in SKAGEN Vext and SKAGEN Global as well.
And indeed, it's a good testament to the fact that long term really pays off. Now let's try to round this up, Alexandra. Do you have any final thoughts?
Well, markets will likely remain bumpy. I mean, they're very nervous these days, and we will get clarity going forward on inflation, on interest rates. I mean, the Fed is coming next week with on the 22nd of March, so we'll see what happens. But it'll be bumpy, but I don't think it will be a massive a change in the short term. I believe inflation is sticky. I believe it will is more sticky than most people believe. I think it will be slower to get it back to 2%. I think we will get there, but it will be slow. And I think it's really important that those who are able to adjust their portfolios to an inflationary environment and this new playbook or new regime will do better or do well. So the key is not to let the daily noise like we're having today disturb your long-term investment plans. Don't risk being out of the market on good days, which we are likely to get once in a while. So I'd just like to share in this respect a slide here. A recent study showed that missing the single best performing day of the S&P 500 between 1970 and 2019 would actually cut returns by an overwhelming 35%. Now that is pretty dramatic, especially if you miss several of the best days. And this really speaks to the benefit of being long-term. And then the final point, which I also think is important, just to remind you, as SKAGEN is an active value investor with concentrated and unconstrained portfolios. And our aim is to do the best fundamental research we can and find companies that will do well in different market conditions, including tough ones.